All right, let's dive right into this explainer. Today, we're taking a journey from a brilliant tech bio business model all the way down to a highly specific risk-managed options trade. We are looking at Recursion Pharmaceuticals, which trades under the ticker symbol RXRX. Now, it is incredibly rare to find a scenario where the underlying fundamentals of a company are literally pushing the boundaries of modern science, yet the stock chart looks, frankly, pretty ugly. But as we're going to explore today, that exact disconnect between a great company and a terrible chart can sometimes create the absolute perfect trade setup for a savvy investor. Here's a quick look at our roadmap for today. First, industrializing drug discovery. Second, the RXRX technical stock analysis. Third, our cash-secured put setup. And finally, number 4, the wheel strategy rationale. Okay, let's kick things off with Section 1, industrializing drug discovery. So what makes RXRX such a fascinating clinical stage company? Well, it's the fact that they are treating biology like an information science problem. You know the old way, right? Painstakingly manual, trial and error research. Well, Recursion just tossed that out the window. They've built this massive, highly automated wet lab. We're talking about robots conducting millions of biological experiments every single week, and then feeding all that massive data straight into advanced AI. They're hunting for hidden patterns and potential treatments at a scale we've never really seen before. They are fundamentally changing the speed of biology. Moving right along to Section 2, RXRX technical stock analysis. So, despite all that mind-blowing tech we just talked about, the stock chart, yeah, it's been completely trapped in a falling trend channel. The price is desperately trying to find a floor well below its 200-day moving average. That average is sitting way up there at $4.56, which undeniably confirms that the dominant trend is bearish. We've got some really heavy overhead resistance right at the $4 mark. So obviously, any break above that would be our major bullish signal, while our immediate downside support is resting down at $3.28. Here's the crucial point. As of the May 1st close, the current price is sitting right at $3.39. It is totally squeezed between that immediate support below and the heavy resistance above. It's hovering in this weird space where it's trying to stabilize, but honestly, it's still very much a victim of that broader downward channel. But I want you to mark this date on your calendar, May 6th, 2026. That's when RXRX reports Q1 earnings, and that is going to act as a massive volatility trigger. It could easily cause a sharp move in either direction. Earnings reports in the biotech space are notoriously explosive, right? When a company updates the market on clinical trials, cash burn rates, those huge AI partnerships, the stock almost never stays flat. And actually, that incoming volatility, that's exactly what we need to properly structure our trade. Which brings us nicely to Section 3, the cash-secured put setup. Since we know that earnings volatility pumps up option premiums, we're going to take full advantage of that. Here is the exact setup we're looking at. We are selling a cash-secured put with the target expiration of June 5th, 2026. We're targeting the $3 strike price, and by doing so, we are collecting an estimated premium of 20 cents per share. That drops $20 directly into your account for every single contract you sell. Now, you might be wondering, why that exact strike price for our out-of-the-money play? Why $3? Why not $3.50 or $2.50? Well, in options trading, your strike price completely dictates your probability of success and your margin of safety. It's literally the single most important variable you have to lock in correctly based on what the charts are telling us. Let's break down exactly why in Section 4, the wheel strategy rationale. If you're on the wheel strategy, you know the golden rule. Your initial strike needs to be a price you are incredibly comfortable holding the asset at. That $3 strike is a major historical and psychological floor that gives us significant breathing room against the current price. By setting the strike at $3 while the stock trades at $3.39, we are building an immediate 11.5% margin of safety. Think about that. The stock had tanked by over 11% after that volatile earnings call, and our trade will still be profitable. Plus, the $3 level isn't random. Round numbers act as massive psychological support levels for institutional and retail traders alike. Let's just walk through the math here, because it aligns beautifully. Step 1, you sell the put and immediately collect that 20 cents per share premium. Step 2, let's say the absolute worst happens on earnings, the stock tanks, and it slams into that $3 floor. Okay, so you get assigned the shares at $3. But step 3 is where the magic of the wheel strategy happens. Because you already collected that 20 cents up front, your true break-even, your actual cost basis, is $3 minus 20 cents. That lands you right at $2.80. If you look back at the historical charts, that $2.80 to $3 range is the absolute bottom of its 52-week low area. You are essentially getting paid to position yourself at the absolute historical floor of the stock. So ultimately, what's happening? You're getting paid to potentially buy incredible AI-native infrastructure at a $1.8 billion market cap, sitting at a historically low valuation. It's a phenomenal setup, but it does leave us with one big question to ponder. Is a $2.80 cost basis really low enough to protect you from the broader biotech bear market, or is this just the beginning of a deeper descent for RXRX? Definitely something to think about. Anyway, thank you guys so much for watching this explainer. If you found this breakdown valuable, please do me a huge favor, hit that like button and subscribe for more. Catch you next time.